Bloomberg Audio Studios. Podcasts, radio, news. This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Lori Calvasina joins us. She's head of U.S. equity strategy for RBC Capital Markets. Lori, what have you seen so far in earnings that you like, maybe don't like? How's the guidance shaping up for you?
It's a great question. I'm going to get over the fact that you said it's only been 335 companies, right, which means we still have a ways to go.
Yep.
That's our depressing thought for the morning. But no, look, I think the tagline we've been using is fine but not fabulous. And I might put a comma after that now, after having gone through last week where I think we had 155 companies. And I would say comma, starting to look messy.
Okay.
And, I think the overall headline stats are fine. The rate of upward revisions to FY1 and FY2 is like 61, 62%. That's moved up from the mid-50s. That's all well and good. We watch very closely the Bloomberg intelligence data where they track the bottom-up consensus estimates, and those have crept up for both 2025 and 2026. If you think about guidance, we've also been looking at some Bloomberg data for this as well. And so the guidance stats look pretty good. The problem is I think a lot of this was well anticipated. And so, coming into reporting season, I heard clients talking about FX tailwinds. Guess what? Stocks aren't reacting all that well to beats on FX. I've been hearing that from my analysts. And if you think about, some of these adjustments to guidance because, hey, the tariff rate isn't as bad as we initially baked in, clients knew that was coming as well. So, I think some of this is falling flat. And when we're looking at, the demand discussion, frankly, was there push-in? Was there, pull forward? Were there delays? I mean, it still sort of seems to be all of the above. The tech companies sound pretty good. I don't think there's been too much interruption on the AI story. But outside of that, it seems like there's a lot of confusion as to how much, kind of pull-in actually happened. You're seeing some companies say there's a little bit, of improvement. Some of that paralysis is alleviating. But frankly, Paul, I mean, the level of uncertainty still seems very, very high. And that is concerning me right now.
Well, even though we've had roughly 40% of the market cap by the S&P 500 reporting, now that we're past most of the tech earnings, we still have NVIDIA on August 27th. But of course, I mean, you've noted in your notes to clients, we still have a number of consumer names coming in the next few weeks. So obviously, Paul and I were talking about earlier when it comes to McDonald's, Disney, but then you still have in a few weeks Walmart and Target. So what are you expecting when it comes to the consumer front, and specifically what you might hear about tariffs from them?
So look, I don't think it's going to be awful, but it might be a little bit of cold water. And the reason I say that is if you think about sort of how reporting season unfolds, we always start out with the financials. And we even saw a couple of the credit card companies, I think last week and the week before echoed this as well. The financials like, hey, everything's fine. Spending is still good. And, like the delinquencies are low and people are still paying their credit card bills. And, we're just not seeing anything wrong. And then you go and actually listen to the consumer companies that watch what the consumer is actually doing. And, maybe the word cracks is too strong, but I would say the composition of the spend is reflecting a concerned behavior. One of the food companies last week actually referred to the idea of people stress eating chocolate, right. Which was probably one of my favorite quotes from last week. But we saw other companies say the consumer is under stress, and that doesn't result in a collapse in consumer spending, but there are some concerning things going on, not just from the high end, but the low end as well. And the Michigan survey on Friday actually showed a downtick in consumer sentiment for low end and lowly educated consumers. So there is something amiss. We're going to hear more about that, is my guess.
And also promotions, because consumer packaged good companies, especially coming into this year, we're talking so much about those types of you're at the grocery store, buy one, get one 50% off. What are you hearing so far with any of that?
So I haven't been paying quite as much attention to the promotion conversation, but this whole idea of the value-seeking consumer ranging from like the high end to the low end is still very much, present. And, I've noticed some of the food companies have been talking about things like smaller pack sizes. I mean, this is sort of going with my own lived experience as the mom of like two little boys who just eat and eat and eat. So I think that value consciousness is still translating into behavior, and you're seeing it, especially for these food companies. There's another company, I forget who it was, but they were talking about how food has just become so much more expensive that it's radiating in terms of other purchase decisions. And so they can really see where consumers are prioritizing their spend.
small to mid cap stocks, what's the call these days?
So, it's interesting with all these developments in the last 48 trading hours. I think the Fed meeting last week threw some cold water on the small cap trade. And Friday was a little bit of a mix, right? Because on the one hand, we got this jobs report that said, okay, there may be some deterioration in the labor market that's beyond what people had assumed. That is bad for small caps. You need jobs growth to be ramping, to be getting better for small caps to outperform. Typically flat to decelerating jobs growth doesn't work for them. That being said, small caps have become the hedge fund community's one of their favorite ways to express Fed bets. And so, when people sort of settled down, and started to think about, okay, maybe the cuts are coming sooner, we'll see how they trade today, but that feels like it should breathe a little bit of life into markets and a little bit of life into small caps. So I would not be short small caps, but I don't have enough conviction to go long yet either. I'd be neutral.
If you go to the S&P 500 and then the A&R function in the terminal, you can see where those consensus estimates are for sell-side targets. And I know, Lori, yours is 62.50 for year-end right now. That would actually just imply about a 0.2% increase from where the S&P 500 closed on Friday. So what's your view for the second half of the year when we're in what's historically the most seasonally weak time period in August and September for equities?
Yeah, so look, targets have been tough this year, right? And I think for us, it's designed to articulate the path that we think the market is on. And the path that we think the market is on, we feel like it's a fairly neutral one. We see risks on both sides. I do think the sentiment rally we've seen since April 8th, that's been consistently our most bullish modeling. And that feels like it's kind of done at the recent highs about what it's supposed to do. It feels like we're ahead of 2025 fundamentals, and it feels like we've already priced in a lot of good news from 2026. And my concern is that maybe 2026, while not terrible, ends up not being quite as rosy as everybody thinks. So that could create some volatility. And as you mentioned, Jess, this is seasonally. If you even just look the last 5 years, August is kind of mixed. September and October tend to be bad. And if you went back and looked at the 2018 trade war, that post-Labor Day period was when investors really started to get concerned based on what they were hearing from companies about the ripple effects of that trade war. So I've got all that in the back of my head. I don't feel bearish. I know when you're not as bullish as everybody else, that's the box people want to put you in. But I feel very neutral. And so that's really what the target's trying to express.
Lori, thank you so much for joining us. Really appreciate you coming into our studio. Lori Calvasina, head of U.S. equity strategy at RBC Capital Markets.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Nobody wanted to talk to fixed income people at cocktail parties. They would be sitting in the corner. Nobody would be talking to them because they had no yield, no return. Now there's some of the cool kids.
Now everybody wants to talk to them.
One of the cool kids is Kathy Jones, Chief Fixed Income Strategist at Charles Schwab. Kathy, what's the overall call here in fixed income? What's Charles Schwab saying these days about how we should have some exposure to fixed income?
Good morning, Colin. No, I'm not one of the cool kids yet, but I'm trying. How's that? I think that we have been in the camp since late last year, keeping an intermediate term duration on average, meaning somewhere in that 5 to 7 year area for an average duration in higher credit quality bonds. We've now considered going a little bit longer term. We think that these jobs numbers, combined with some of the other numbers we've seen lately, do suggest a slowdown in activity, the greater likelihood of Fed rate cuts coming. And that suggests us that it's not too risky now to extend duration a little bit from here. A 10-year yield, probably not going back to 4.5%, 5% area, probably staying under that 4.5%. And if the Fed does end up cutting rates, which we think they will in September, then you'll see the whole curve shift down, but you probably do a little bit better in the intermediate to longer term duration because it will be a cut as a result of slower economic growth.
When you're looking at the 10-year Treasury yield, are we in a world where 4.5% may be the new normal for that?
Well, I think it's probably at this moment in time the upper end of normal. But yeah, I think, when we look at where rates were for that long period of time when, we couldn't get a conversation at a cocktail party because they were so low, now we're going back to, what is considered more normal. If our normal growth rate is between 1.5% and 2%, then a 4.5% 10-year yield, given 2% inflation, say, is probably a more normal kind of standard real yield that you would get relative to history. So I think that 4.5 probably the upper bound for the time being, but somewhere around 4% on a 10-year is probably the new normal.
Kathy, how about credit risk here? I'm looking at the INGO function on the Bloomberg terminal, and I see that the best performance in U.S. fixed income has been U.S. corporate high yield. So it looks like the market's okay taking some credit risk. How do you think about that?
Yeah, we're a little bit wary of going too far down the risk spectrum, the credit spectrum in fixed income, just because you don't get paid for it. It doesn't, it doesn't give you much spread. And the economic fundamentals showing softness means that we'll probably see those default rates go up on the lowest credit quality bonds. So we're a little bit careful about that. But look, high yield, as long as there's no recession, you get a lot of yield, and that yield is what gives you the total return. It's been a very calm market, and that's allowed people to hang in there in high yield. So our perspective is it's okay to have some allocation to high yield. We wouldn't over allocate to it, but you have to be ready to ride the ups and downs in that. From a long-term perspective, those yields are pretty attractive, and you compound them over time, and that gives you a decent total return. But you're going to have a lot more volatility there and a lot more correlation with equities. So allocation matters, sizing, but the position in high yield is really important.
What's top of mind for you on the economic calendar this week? I know we have durable goods orders coming out at 10 a.m. New York time later this morning.
Oh, jobless claims. Anything to do with the labor market right now is really top of mind for us because we've seen such big revisions. We've seen so much attention now to the job market. It is a bellwether for the Fed, obviously, because it's part of their mandate. So those weekly jobless claims take on a lot more importance now.
Hey, Kathy, as a bond investor, what's this weak dollar mean for you guys? I mean, we've seen the stocks bounce back. A lot of other risk assets have bounced back after the sell-off earlier in the year from Liberation Day, but the dollar really hasn't. Still down. The Bloomberg Dollar Index is still down about 8.5% this year. What does that mean for bond investors?
Well, I think it's a good indication that the market expects those interest rate differentials to narrow vis-a-vis, say, Europe and some of the other major countries. It makes international investing in bonds a bit more attractive. It's been a good 10, 15 years since that's really been an attractive option for a lot of investors, particularly in developed markets. But now if we're going to see the dollar go down, that's a big component of return when you invest in international developed market bonds. So it means diversification actually is an opportunity now. You still get a somewhat lower yield, but the play on the currency side, if we're right that it continues to go down, can give you pretty good returns. And actually, year to date, the strongest performing sub-asset class in fixed income is international developed market bonds because of that drop in the dollar.
Where do you see the long end of the Treasury yield curve headed? And do you think that will remain more stable when you're thinking compared with the short end that could potentially rally if the Fed does begin to lean more dovish into year end?
Yeah, we're still looking for a steeper yield curve with the short end kind of leading rates down and the long end kind of hanging in there, coming down. We're seeing yields come down at the long end, but I think given that inflation is still elevated, we have components of policy that are bearish for long-term bonds, or at least limit the decline in yields in long-term bonds. So between deficit financing that's coming up and the inflationary impact of tariffs, most likely what we'll see is that steeper yield curve. So the whole thing shifts down, but much more at the short end than at the longer end.
Kathy, thank you so much for joining us. Appreciate it. As always, Kathy Jones, Chief Fixed Income Strategist at Charles Schwab.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Kara Murphy joins us. She's the CIO of Kestra Investment Management. Kara, what's the call to your clients these days here? We've got earnings coming in. We've got a Fed that I guess is going to cut once or twice this year. Is that enough to be supportive of risk assets these days?
I think that's the important question. And what we've seen is this like battling narrative between policy uncertainty and big changes when it comes to things like tariffs. But then underlying, when you look at companies' earning potential, it continues to come in quite strong. So obviously, we've seen a lot of noise from tariffs coming into, you saw GDP much weaker in the second quarter. You've seen earnings take a slowdown in the second quarter. Late last week, we had the revised jobs numbers coming down. So it's definitely taking an impact. But then when you hear companies talk about their outlooks for the second half, those are still coming in pretty good. And so those will continue to support stock prices.
Well, Citigroup was pointing out, Stu Kaiser, how they're crunching some of the numbers here. The S&P 500 average stock has moved about 5.2% in either direction for the second quarter earnings season. And that's the highest in their data history going back to 2012 at this point in the earnings season cycle. So I'm actually curious when you're looking at these kind of names, Kara, as far as when you're having more volatility within some of these single stocks, where are you seeing those types of opportunities and what are you buying, what are you selling?
Yeah, and I think it's very interesting to point to that because when you look at, say, like the percentage of companies who are beating estimates relative to what you typically see in history, we're pretty much on the nose with long-term averages. So in terms of like the overall earnings power of the S&P 500 companies, they're about like where we had expected them to be. But you're right in that what we've seen that's different this particular season is that investors are rewarding those who beat and punishing more those who miss. So I think part of this is that as you think about the rebound that we had off of the low in the market in late April, it was sort of a buy everything type of rally. Now, as we're seeing numbers, we're understanding a little bit more how individual companies are impacted. You're seeing the market really differentiate between those who can earn and those who are struggling.
Kara, this is an equity market that increasingly is concentrated in, a handful, a dozen names, big tech names. And I don't know, I learned in business school that's not necessarily a good thing. How do you think about that as a risk? Maybe as an opportunity, I'm not sure.
I think this is definitely a risk for broad market investors. And this is one of like the main risks that we had pointed to at the beginning of the year. So this high valuations and policy uncertainty. So we saw policy uncertainty rear its ugly head in the second quarter. But then with this rebound in the market, we were back to like a super concentrated market. And as long as those like Magnificent Seven names or whatever's leading the market, as long as those names continue to be able to show earnings power, I think we're okay. That said, that concentration combined with really high valuations make a market more vulnerable. That doesn't mean it's going to turn down, but if that earnings picture starts to change, then the whole index is really at risk. So we've been, big advocates. We think 2025 is the year of the diversification trade, which hasn't been a very sort of sexy thing to talk about, but we've seen it actually work. So bonds suddenly matter. Owning things outside the US suddenly matters. We think it's important to own things outside of those big names. And that's going to provide you the cushion that you need over the next couple of years.
Of course, we have Palantir reporting after the bell today, another big name that has moved markets and especially had been added to the S&P 500 most recently too. When you're thinking about some of these names that are coming up, what's the most important company names to you that you're going to be keeping a close eye on as far as weightings and what could move markets more so?
So I think, we've talked a lot about the AI trade, and obviously that's been a really important mover of the markets over the last couple of years. And it's important not just for those individual companies, but what it means for things like productivity of the US economy, for the foreseeable future. And we think that's going to continue to be a trend. So being able to hear not just about the capital investments being made there, that's almost easy to do, but what are the actual returns on those capital investments?
Kara, fixed income, what's the play here for you? Because I look at the returns on the Bloomberg Total Return Index. I see corporate high yield has been the best returner this year.
Yeah, and typically that's like the most correlated with equity returns. So it kind of makes sense as you have a big rallying market that's going to perform well. That said, we have some of the same issues in that asset class that we do in some of the really large equities, in that there's not a lot of risk priced into those markets. So you have extremely tight credit spreads. That said, when we look at like corporate America overall, we think it's fairly healthy. And so we'd be biased towards more higher grade corporates where you can get a little bit more absolute yield, but you're not as vulnerable to, say, a turn down in credit.
So when you're speaking with clients, what are their top concerns whenever they're speaking with you right now?
Well, it often depends what side of the aisle they're on. So folks on the left of the aisle are very concerned about policy risk, political encroachment of, sort of economic institutions. If you're on the right side of the market, I think you feel, right side of the political aisle, I think you feel a lot better generally about the market. And they're focusing more on some of the things like the policy changes that we got with the One Big Beautiful Bill, accelerating capital investments, that sort of thing.
Kara, thanks so much for joining us. Appreciate it. As always, Kara Murphy, CIO of Kestra Investment Management.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.
Celeste Balafas, CEO, Gold West Advisory. She's in our studio here, which is a very good thing. What are you doing with these markets here? I mean, boy, we've had an unbelievable volatility to get to here the early parts of August. And now we're up 8-9%. It's like nothing happened, but it's obviously been a very challenging, volatile year to date. How do you reset for your clients here in August?
We're having lots of conversations, but to be honest, we're optimistic. We're excited about the markets moving forward. They are vulnerable, right? So we're paying attention to that, but we're having a lot of conversations with clients. For clients that don't need to have as much stock exposure, we're rebalancing, we're pulling back. We have our cash set asides. First things first, what's your cash flow need for the next 12, 18 months? So we have that cash aside, but for the rest of it, we're excited on equities, not only public equities, but private markets as well.
When we last spoke in June, you were neutral weight equities. Are you still neutral?
Still neutral weight. We still have the same mix of public equity exposure, quality growth companies, and some dividend stocks. That's the primary focus of our portfolio. We did increase also our international exposure slightly since then, but for the most part, our portfolio, our public equity portfolios are intact over the last few months.
Where internationally do you see opportunities?
Mainly Europe. It's mostly Europe exposure that we have. A little bit of emerging markets, but it's mainly Europe that we added to. That the defense spending that the Germans were committed to, that takes some time to play in, but we expect that going forward. So Europe is the biggest international exposure.
How much cash are you holding now versus maybe, I don't know, kind of an average for you guys?
We're pretty fully invested for the clients that don't need cash. Okay. So for anyone that doesn't need cash or doesn't expect to need cash, we're pretty fully invested. Having said that, we do have some fixed income set asides because life happens and of course unexpected cash needs come up. But for those that have a monthly or annual distribution, I have 12 to 18 months of cash aside. For everybody else, I want to be fully invested. And that doesn't mean we can't take advantage of the dips with our fixed income exposure, but I want to be fully invested.
One of the defensive names that you had brought up the last time we were speaking was Lockheed Martin. When you're looking more specifically in the US, how are you viewing that stock now?
Yeah, so going back to the European theme, the European defense spending that I think will play out, Lockheed Martin has a good percentage of their revenues coming from overseas. So still positive on that name. Even more so, I'll say, that's a defense company, of course, defense tech, Shield AI. So I'm looking more so in the private market. So we have our public exposure with Lockheed, but looking at some private markets as well. So Anduril, you may have heard of, defense tech, Shield AI, that's another exciting one. So again, looking at defense, not only in public, but private markets more interesting.
It's kind of where I want to go, because in your notes you say you like venture growth.
Yes.
What is venture growth, and how do you get your clients exposure to venture growth?
Yes, great question. So venture growth, private companies, they're not early stage venture. These are companies that are close to profitability or at profitability or in line of sight of profitability 2 to 3 years out from an IPO or an M&A liquidity event. But venture growth companies have been, we saw the peak of venture bubble in 2021. Since then, valuations have been pretty muted. So opposed to public markets where valuations are on the higher end, and we have a concentration in the S&P, right? 40% of the S&P made up of 10 names. Looking at private markets. So how do we get access? It's a lot of work. We do have a fund set up. That first fund is closed. I mentioned Anduril Shield AI. That fund is closed, but we have a fund. We bring investors together and we do a lot of networking, deal making, talking to a lot of different people to get access to some of these private companies.
And speaking of those private companies, something you brought up in recent months was recess when it comes to those alternative soft drink makers. Talk to us more about that for people who might not know enough about that and why you see those types of opportunities there.
Sure. So Recess is a beverage company. You may have heard magnesium helps us sleep at night, makes us calm down, relax.
Lisa's nodding her head.
Right. I could use that.
So maybe you want to try some Recess drinks. What's been interesting is the growth rate of beverages, better for you beverages and all non-alcoholic beverages. That growth rate has been faster than alcoholic beverages. So Recess is one of those companies that has that magnesium and more calming effect. So if you don't want an alcoholic beverage because you don't want the effects the next day, this is a healthier. And, a lot of the younger generation looking at, wellness and healthcare. How are we more healthy? So this plays right into that space.
It's like when I'm thirsty, I get some water to drink. The kids, they hydrate. That's the difference. I'm like, why are you filling up this jug of water when I need to get back to the studio in 30 seconds? To fill up my little cup of water.
You're not wrong.
Hydrating.
They are.
Okay. All right. Very good. Alternatives. Savasti, how do you guys think about alternatives like as an allocation? Is it 5%? Is it 0? Or is it something more?
It's more. So alternatives, broad category. So there are different kinds of alternatives. But let's say in our typical portfolio of a 70% equity, or what was thought of as a typical 70-30 portfolio, we have a good 10 to 15% of alternative investments, not only private equity, venture growth, but structures as well.
Interesting. I mean, there's a lot of ways to go out there, folks. And smart people like Savasti Balafas, they figure it out for you. Savasti Balafas, CEO of Gold West Advisory, joining us here in our Bloomberg Interactive Broker Studio. We appreciate getting a few minutes of time here.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Newspapers, Lisa Mateo, what do you have for us today?
This one, actually, I want to ask you a question before I get this, because this one is: how many of your kids have gone to grad school? Have they gone?
None. So they're all working.
Okay.
We have one more to go, so that's
so that ties into like this next story. That's why I wanted to ask you about it. So this is in the Wall Street Journal. It's talking about how the tough job market, like a good case for college grads, is to do that so that it makes you stand out. But now they're saying, is the extra debt worth it?
You're right.
And that's what these kids are facing. So, they had the unemployment rate for graduates fell in May. AI is taking out some roles. Uncertainty around the impact of higher tariffs. So companies cutting back or slowing hiring. These are the things that they're facing. So now experts are telling the Wall Street Journal, here's what you need to do. You have to look at how much of a salary boost you can expect to get from that advanced degree, and then how much of a burden that total debt load is going to be. And that's what they should be asking themselves.
I don't know. My dad told me I'll pay through undergrad, and then anything after that, you guys pay. So my sister went to law school. She paid. I went to business school. I paid. I thought that was a pretty good deal. So I've said the same thing to my kids.
Okay.
But if number 4 comes up to me and says, "Hey, I want to do something," I might cave.
You might cave. I feel like the cost though for a master's degree is skyrocketing.
Yeah. Well, that's what. And then you have like the changes in the spending. In the spending law.
It's a tough gig. But for a lot of people, like again, I was on the board of the Duke Business School for 12 years. For still a lot of kids today, if you want to make a career change, it's still a good way to go.
Still a good way to do it. There you go. Okay, this one was from the New York Times. So Curtis Sliwa, right? You know, the Republican nominee for mayor. He's been sporting this new look lately. He's been ditching that Guardian Angels red beret. You know, he's known for wearing it, the red jacket, for a suit, especially when he meets with like business leaders, union officials, things like that. He's also said he will keep it off permanently if he is elected in November. So he's telling the New York Times that some people are turned off by it because they say it has this revolutionary look to it. So if it takes, him taking it off to have people listen to him, he wants to do it.
We interviewed him 3 weeks ago here at Bloomberg in this studio. I interviewed him. He had it on. Yeah. But I don't know. He had the suit on. I don't know. It's just, to me, I've always known him with the beret.
Right. It's just like his trademark.
Yeah, I don't know.
That's how you've known him. It's like how Tom Keene always has the bow tie on.
Exactly.
It's like, it's how you recognize him.
But sometimes he is. And it's funny because people are saying, oh, didn't recognize him. Right. Like without the beret.
Yes.
He wasn't wearing it. So that's a different sector. And so this one is up your alley. Wall Street Journal, this is the AI struggle for Hollywood studios. So what they're doing, especially Disney as an example they give, it's this balance over how to use AI in the filmmaking process and then how to protect themselves against it at the same time. So Disney, I didn't even realize this, when I began working on that live action version of Moana, they actually considered whether to clone Dwayne Johnson for it. So apparently Johnson has a cousin who looks just like him. He's 6'3", he's 250 pounds, okay?
There's another Rock out there?
So he would fill in as this body double for a few shots. Disney would work with like this AI company to make these like deep fakes of his face that would be layered on top of his cousin's body. God. But the problem that Disney attorneys were like, I don't know about this because they can't claim ownership over every element of that the firm if it's AI generated in part. So this is like that struggle they're dealing with. We want to do this technology, but do we still own it, or what are the repercussions from using it, and what are the fans going to say? Like, that's not the real Rock. I mean, come on.
You would know. Lisa Mateo would know the difference.
I would know.
I don't know. I mean, this whole AI and the content creation thing, I don't know how that's all going to work.
Movie studios, it's going to be a change, but it's this back and forth struggle for them.
Very good. Lisa Mateo with the newspapers.
This is the Bloomberg Surveillance Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.